Hello and welcome to the Kingsview Investment Strategies Q4 market update. My name is Scott Martin, Chief Investment Officer and Portfolio Manager at Kingsview Investment Strategies. Joining me today, a familiar face, Paul Nolte, Senior Vice President and Portfolio Manager at Kingsview Investment Strategies. Paul, thanks for joining us again amongst your busy schedule and a busy market schedule at that. Let's dive right into the portfolio machinations, the things that we want to update you on today as far as how we've been managing some of the portfolio changes at Kingsview Investment Strategies, as well as maybe provide a little bit of insight and outlook into how the markets are behaving and some of the data points that we're looking at today that we think are going to be pretty consequential as it comes to the next, say, few months as far as the market's going to behave. Paul, let's just dive into kind of the elephant in the room, please. The volatility in the markets these days as we come to you in, say, mid to late October here as far as this recording goes. Volatility is through the roof. Downside is big time in the S&P and NASDAQ and some of your favorite indexes. Interest rates have backed off a bit. Can we talk a little bit about what's been going on with some of all those asset classes?
What's interesting is we came off of the third quarter, which was very flat as far as volatility goes. We had a great third quarter.
Almost non-existent. I mean, talk about a sleeper.
Up. It was very similar to 2017. And similar to 2017, coming into the volatility or coming into the beginning of the quarter, we saw that volatility pick up. And usually when volatility pick up, that means we're going down. And we've come down a bit here in October. So the concerns haven't changed. Interest rates are going higher. We still are talking trade tariffs. Maybe earnings not as good as they were in the second quarter. All of those were known all through the third quarter, but now things matter. And so investors are getting a little bit more concerned at this point, and part of this reason that we're seeing the selling. So we get into that, we went away from the virtuous circle. We're now in the circle going the other way where, why are people selling? Well, because the markets are going down. Why are they going down? Because people are selling. And that's really what we've seen here. And I think really when we get close to the midterm elections, which are coming up in a couple of weeks, I think we're going to get some very good clarity. Obviously, that part of it goes away. And we could actually get into the best part of the year, and from a calendar basis, from November to May. And we should see a rally.
Period. Yeah, absolutely. And here's the thing. I mean, you talked about circles, and I think of the circle of life on most of the markets, which is this circle, Paul, where they have to deal with higher interest rates. I mean, it's about time that interest rates got off the floor and at least got somewhat near normal, and they're not even there yet. And we've already seen interest rates back off in the last couple weeks as market volatility has ticked up in, say, equities. Talk to me a little bit about how the data points, so looking at jobs, GDP, consumer confidence, spending, and so forth, have kind of maybe motivated interest rates to maybe tick up a bit, which has probably been a reality that's a long time coming.
Oh, absolutely. I mean, we heard from Chair Powell early in October, just after they announced the rate increase. He came out and said, the economy is doing better than we ever expected. And traders took that as meaning, they're hiking rates and they're going to be aggressive about it. And really that was kind of the beginning of the trading that we saw, the decline in the markets. But the Fed, if you listen to the Fed, they are going on the plan that they've set up since Yellen left. She said, here's what we're going to do, and he's followed that roadmap. So we're going to see one more increase this year. We'll see probably two more next year early, and then maybe a lot of stuff up for grabs. But again, those higher interest rates have an impact on valuations, and that's part of the reason why the markets are coming off, because they're realizing they're not kidding. They're going to raise rates.
And it's something that I believe, and that we believe as far as our investment committee goes and the meetings that we have amongst our team here, that the market will eventually get comfortable with rates at this higher level, whether that is 3.10 on the 10-year or 3.25 as we saw in the 10-year high just a couple weeks ago. The market will get comfortable here, and I think it will rally again, or at least maybe stabilize. But to that point, Paul, you mentioned valuations, and something that we talked about in the last couple missives that we wrote about, and the changes, some of the changes we made to, say, the multi-strat portfolios and the others. Talk to me a little bit about that difference now that we have in value versus growth that has suddenly emerged as a great opportunity, that's been going on for some time now.
It's been the growth market, the growth side of the house, if you will, has done phenomenally well since the bottom in 2009. And since that time, growth has outpaced value to historic levels. And when we take a look at the relationship between the PEs on growth and the PEs on value, we haven't seen this big a difference since 2000.
Wow.
So right now, value is very cheap relative to growth. And part of the reason why we made that shift, we said, all right, well, it's not time to abandon growth entirely, because it can still run for a while. but we're starting to make that shift over to the value side. And we see that not only in the US, but we're seeing it international. International has gotten really beat up. The markets there, the valuations there are even cheaper than the United States. So we've got exposures in emerging markets and in Europe and some of the bigger countries, more developed countries. Great values, great valuations. It's going to take some time, I think, to play out. And if we're right from the perspective of maybe this is a shift, value will probably go back and beat growth for multi-years.
That's right.
Not just a couple
And it's already
weeks.
been a nice downside hedge on some of these bad days where growth has been just thrown out the window. Value is held up. And I think similarly so on some of the fundamental economic analysis we do, Paul, on say more the sector basis. You know, we've seen things like utilities pop into the portfolio, which tend to be a more value-oriented thing. So we're starting to see that show up in the data as well, not just on a valuation basis, which is really exciting to see as a fundamental guy at heart, to see the data points actually line up with some of those valuation discrepancies. Hopping over to the fixed income side of things, which is obviously a hot button given how rates have behaved, given how you mentioned the Fed is positioned. I'm not 100% sure I agree with you that they're going to do another 2 rate hikes in the beginning of the year, given how nasty the market environment is right now. But things could settle down and they could feel comfortable to move forward on that, as they have indicated prior to. So yes, there could be some more rate hikes to come after December, which is definitely a done deal. Let's talk about some of the changes that we've made in the portfolios, Paul, on the fixed income side to maybe mitigate some of that interest rate risk, please.
Well, a couple things. One, we're getting a little bit more defensive. We moved a little bit away from high yield. We're looking more at hedging those higher interest rates. And high yield has been a very good performer. It has been kind of an equity-ish type
proxy,
in the market. So it's done very well, taking some of that risk down and then moving to a little bit more of a go-anywhere type of mutual funds or investments where the duration's a little bit shorter. So we've brought our duration of the portfolios in, which means that it's not as sensitive when rates go up. So if rates continue to go up, the fixed income portion of the portfolio should hold up well. We've introduced a little bit more in treasuries as well, and those treasuries generally have held up better than the equity markets as the equity markets have transitioned here, especially this month. So again, a little bit more conservative on the fixed income side, anticipating somewhat higher rates, and certainly the same also on the equity side. So playing a little bit more defense than we have at any point in the last 3 years. And I think it's been appropriate and it has worked out very well so far.
Yeah, and I think similarly so, speaking of appropriateness, we've got a few big, I think, data points / events coming up. We've got a report on GDP coming up in a matter of days with respect to Q3, which is, yes, backward looking, but it still solidifies, I think, some of the data points that we've been following the whole way here that does suggest that the economy is getting better, or at least is still strong.
True.
Secondarily, we've got the midterm elections, which, as we've seen from the presidential election a couple of years ago, could go any way, so that could obviously surprise the market. And then just that general little Q4 kind of excitement, let's say, that comes in with a Santa Claus rally, or pick your favorite, Christmas time person with respect to how the market rallies into, say, the end of the year, just as, say, 401ks hit and everything like that.
Right.
So talk to me a little bit about that seasonality that tends to hit the market around this time, or starting, say, in mid-November into the end of the year, that may actually support stocks.
Yeah, no, absolutely. And October has historically been one of the more volatile.
Very true. Great point.
October tends to be the most
So it's
volatile.
living up to its name.
It absolutely is. The worst 2 months of the year are actually August and September. But volatility-wise, October is one of the most volatile months of the calendar year. Tends to also mark the bottom of the calendar. And that's when you normally will see the rallies into year end as we start looking toward next year. We're a little more positive on the year, 401k contributions, all the money coming into the market. So historically, at least, from the beginning or the end of October through, again, March, first quarter, markets tend to act very well, anticipating. The elections are kind of a wild card, but I think for a very small window. You're going to get a reaction for a day or two, and then the markets are going to go back to the fundamentals.
Yep.
How does the economy look? How do earnings look? And that's really what's going to drive long term. So we might get a pop, we might get a drop, but again, I think that's going to be just a very short term.
And that's a great point. As long-term investors, I know it's really hard on days that we've seen recently to keep that long-term focus, because the media is so crazy about the last 100-point drop in the Dow, and then the 200-point rally, and then the 300-point drop. But the reality is you do have to keep your focus long-term. The last piece I want to touch on before we go, Paul, the recession risk ratio. The piece that we like talking about internally, that we talked to you about several times, on these reports, is talking about how the recession outlook actually appears with respect to the U.S. economy. Can you give us a quick update on that, given the data points and their behavior of late?
What's kind of interesting is with the higher rates that we've seen, and we've seen the moderation of inflation, it's actually moved further away from recession. We got very close in September, and we thought, okay, if it continues this trajectory, we're going to be there by the end of the year, certainly. It's actually gone the other way. So again, we're not calling for a recession. We don't really see the data points falling apart. Housing is a little weak, autos are a little bit weak, but employment is still very strong. The GDP should be good. But again, I think it suffers
Spending's
from...
good, yeah.
But it suffers from comparison, and I think that's really more the issue, because second quarter was so good. Third quarter is going to be a good number, but again, it's going to be a little bit less, and I think that's part of what has the markets a little bit squirrely here. But again, from a recession perspective, we're not seeing it yet, and I don't think we're going to for at least the first half of next year. The second half of next year, again, depending on how aggressive the Fed is, we might see something break. But right now, it's not in the cards.
Maybe a little uneven until then, but at least positive as far as we're concerned for now.
So absolutely.
I think that's great stuff, Paul. Thanks for joining us and taking the time to give us some insight. And thank you for watching us today. If you have any questions on anything we said or any comments, please reach out to your investment advisor at Kingsview Asset Management. Thank you again for joining us.